Welcome, 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 everybody. Welcome to Crashes in Taxes. I am your host for this podcast, Rebecca Walser. So excited to be with you. We're getting so many new subscribers. So for those of you that are actually referring this podcast out to your friends, your family, thank you so much. I just want to say that I absolutely do appreciate it. It means a lot to the practice and to our extended network, and we really do appreciate that. Today, I'm going to be using this little teeny tiny whiteboard. Isn't it so cute? And we're going to actually be going through some numbers. So if you can listen to this podcast at all in any way on video and watch it, because we do have a video podcast, then please watch it, because I'm going to be writing some numbers down like a little teacher today. I'm really excited. And I want to talk to you today about the opportunity that we really have in 2021 specifically. And we're going to talk today about the opportunity in 2021 with tax. So this is going to be specific to people that might potentially have an estate tax. Now, in 2021, the estate tax exemption. And let me explain this. This is your lifetime exclusion amount, or what we call now your basic exclusion amount, your BAE. Your BAE, your basic exclusion amount, let's just write that down. BE, I'm saying it backwards. BEA, your basic exclusion amount. Your BEA is something that is computed based on your lifetime gifts and the transfer of wealth that would occur at your death. So what does that mean? If I have, and before you tune out, there's a very specific reason I'm going through this. So right now, a person can transfer wealth of about $11.8 million without having an estate tax, okay? So clearly there's not a lot of people around the country that have nearly $12 million. And right now, if you're married, we have portability, which means that you can actually double your exemption between the spouses. So you could easily be at almost $24 million of wealth passed down without any estate tax at all. So a lot of people are going to be like, well, that doesn't apply to me. And this is the reason I'm doing this specific podcast on this specific topic, because we now have a new administration. And this new administration has already said that they want the taxes to go back and revert to what they were in 2009. And the 2009 estate tax is extremely different than the regime that we've been under since 2010. So again, in 2021, your basic exclusion amount is approximately $11.8 million. All right. And if you're married, you would 2x that, because you would be able to use the unlimited marital deduction and basically get 24 million basically passed down without any estate tax. The estate tax right now is flat 40%. So that means if you had $30 million, you could escape tax on 24 million, but $6 million you're going to pay 40% or $2.4 million. Now this is under the current Trump tax plan that came about in 2018. So we did have some Trump tax plan changes in 2018. Now, Trump's tax plan that came out in 2018 had a provision in it called a sunset provision. And what that means is by the end of 2025, this provision would sunset. In other words, we would revert back automatically at the end of 2025 or the beginning of 2026 to the 2019 estate tax. What does that mean? What was the estate tax in 2009? Well, in 2009, the estate tax exemption was $3.5 million. So 3,500,000 or $7 million per married couple with using portability. So we have $7 million as a married couple, and the estate tax back in 2009 was 45%. So these are the 2009 numbers, 3.5, $7 million with a married couple, 45%. So what happened when Trump's tax law passed in 2018, the Tax and Job Jobs Act 2018, what happened was it was clear that we had this portability, this higher exemption that would revert back down in 2026 back to 2009 levels. And so we needed guidance as tax lawyers from the IRS, because obviously we do a lot of gifting during your lifetime. So you combine your lifetime gifts with your transfers through death, and that equals your total lifetime death transfer of wealth, we call your BEA, your basic exclusion amount. Now, the problem with the sunsetting is, let's say that I had a client, I'm just going to give you really high level numbers so that you can just follow the math really easy. Let's say this client comes in and they have $100 million, right? And so clearly we have an estate tax issue. Well, right now, I would say, all right, if that person's married, right now we have 24 million that can escape estate tax. That means we obviously have, an additional $76 million that we have to deal with estate tax planning. And there are definitely things that we can do to plan for the estate tax. But that would give me this massive amount that I need to take care of. So I might start doing massive gifting strategies. I might move things to things that are outside of my estate, that I can do that legally. I can legally remove an asset from my estate, give up all legal rights to it for the rest of forever into perpetuity, and I can remove it from my estate that way. So there's some things I can do. And so as estate tax attorneys and tax attorneys, we needed guidance from the IRS to tell us if we recommend that our clients gift things while the exemption is bigger, and then they pass away some 25 years from now and the exemption is smaller, are we going to have to pay the estate tax on what the smaller exemption is? Because otherwise, all of our planning, if that's the case, then our planning that we did when the exemption was bigger would be completely what we call moot in the law, M-O-O-T, meaning completely legally irrelevant. And so the IRS issued proposed guidance in 2018 when Trump's tax plan first came out. And the proposed guidance said that if you make estate tax plays and changes while the estate tax exemption is bigger, then we will honor that estate tax exemption when the date of the gift was made or the date of the transaction happened. We will look at the then lawful exclusion amount and we will use that exclusion amount, or we will use the one at your death, whichever one is bigger, basically. And so as long as you actually had transactions, you have to avail yourself. You have to actually take ownership and make the transaction happen while the estate tax exclusion is bigger, because if you don't, you will miss it. In other words, if you didn't actually do it, you can't say, well, at one point in my life, the exclusion was bigger, I just didn't use it, and now I'm dead and it's $5 million and I have $7 million and I want to use the bigger number. It doesn't work like that. You have to actually affect the transactions when the exclusion is actually bigger. So this is the whole reason for today's podcast. Right now, we have this massive 11.8, and we know that Biden's tax proposal, as he's already projected, is basically going to come down to the 2009 level of 3.5 million and at a 45% rate. Now, here's the problem. This coming back down to 2009 levels does not include the retirement of the baby boomers, which is now headed towards us full speed ahead, such that we expect an additional 60 to 65 million people to retire between now and 2028 in the next 7 years. So now's the problem that we have. We have already dissected multiple times on multiple episodes how the coming retirement of the baby boomers is going to create a tax crisis in our country, because it will be the first time in forever, we've never had this happen before, where we actually have an entire third of our population on Social Security and Medicare. So that means if you think about it, you've got 1/3 basically working, 1/3 that are too young to work in school, whatever, and then you have 1/3 that are going to be on these systems. And that is going to require a lot more taxation to continue to support these people on Social Security and Medicare. And that is why the CBO, the Congressional Budget Office, gave us a projection in 2008 based on the retirement of the baby boomers that we would see tax rates for the middle class in the 60s. I will just say that again. We expect that the retirement of the baby boomers is going to completely upset the apple cart of taxation in America, such that the Congressional Budget Office did an analysis and study in 2008 where they projected that the middle class tax bracket will be somewhere in the 60s. And the lowest class bracket, or the lowest bracket of the code, would be somewhere around 25, and the top bracket would be somewhere in the 80s. So, if Biden's administration passes a tax law later this year, and I'll come back to why it has to be later this year in a minute. If they pass a tax law later this year that goes into effect in January of 2022, that reduces the estate tax exemption from 11.8 down to 3.5, that means we are literally losing the ability to shelter $8.3 million per person, which would be $16 million per married couple. So you might be saying, again, I don't have 8.1 million. I have, well, here's the problem. Because the baby boomers are going to so upset the tax system that we have in America, I project that we will have additional compression on the BEA, the basic exclusion amount, down from 3.5 million to roughly $2 million per person. So I am projecting that the retirement of the boomers onto Social Security and Medicare, and the result of that will force them to shine a spotlight in every nook and cranny they can in this country to collect more taxation, and that action will also include them reducing the basic exclusion amount from 3.5 million to $2 million. And $2 million doubled for a spouse is $4 million. So now you're talking about a substantial amount of the country that is now impacted with only a $2 to $4 million single to married exclusion. And I also am projecting that the tax rate on the estate side will go from 45% to somewhere in the 60+% range. What this means is if you have $5 million, $1 million of that $5 million will be estate taxable, and I'm projecting at about 60%, or you will lose $600,000 to taxation. Now, I mentioned that we're not going to know, and this is the whole problem, right? We're not going to know if this is going to happen until later this year. We've already had Biden tell us that this is what he wants to do. And we know that he has both the House and Senate that he could actually get this passed through. We're not going to know, though, because just like Trump did in 2018, they have to use the budget reconciliation process to pass some of these tax law changes. And in order to use the budget reconciliation process, it's going to really take through till October where they can actually make those changes. So it's very possible that we won't know what the coming tax law changes are until the very last quarter of this year. And what that means is if you are one of those people that does have an estate tax problem now, right? You do not want to not take action in 2021 and just watch your $8.3 million exemption just disappear when the IRS has ruled that if you effectuate transactions in the year where the exclusion was higher, they will honor it. So if you have a large estate and you have not done this planning because the exemption has been so high at almost $24 million, then this is the year 2021 for you to actually take action. But more than that, for anybody that thinks that as a married couple, some 20, 30, 15, 10, 5 years from now, they will have more than $4 million at their death that they will be passing down to their family, their heirs, their whoever, then we need to do some estate tax planning. And we only have this year to do it because by the time the new tax law is in place, we have lost the ability to use that exclusion amount. It is gone forever unless they magically raise the BEA again. And of course, that is very unlikely, totally out of the realm of possibility in my professional opinion with what's about to come in these next 7 years with the retirement of the baby boomers en masse. So I tell you all of this to let you know that tax policy is changing, and that if you have any size of assets, you might want to make some moves this year to recognize a higher thing. Let's say that you have $1 million. I wish I could run a future value calculator and show you guys. But if you have $1 million and you compound that $1 million for 30 years at a 6% rate, let me just do it while I'm literally on the podcast so you guys can understand what is happening. I literally had a client just this week. He thought he had no problems with an estate tax, married with $3.5 million. But with what he was doing and how he was earning money, it was growing at a relatively high effective rate. And we had to literally show him that he was basically going to have about a $30 million net worth at his death, and that we needed to do planning around this. So $1 million today for 30 years. So if we compound at a 6% rate of return for 30 years, $1 million, it comes up to $5.7 million. So you might think right now, I don't have an estate tax. I'll never have $5 million. But if you have a substantial amount and you have a long life expectancy ahead of you, you absolutely could grow into an estate tax problem. And that's, of course, what the government would like, right? They would like more people to not think they have an estate tax issue, not do the planning that they could do in 2021 legally, miss the boat, if you will, and then all of a sudden now tax rates are higher and people don't have the exemption that they could have used in 2021. So this is a really interesting topic for a lot of people that think that they don't have any estate tax worries, they don't have any worries. Remember, $1 million at just a 6% rate is almost $6 million in 30 years. So yes, you easily could have an estate tax problem, and that is where we like to look at planning. As far as other tax law changes that this administration has already talked about we already know they're looking at a return to a 28% potential capital gains rate. We're looking at the step up at death being eliminated. That is the Section 1014 that allows you to step up what's inherited by your family or your heirs to the fair market value, so that there's no capital gains taxes or income taxes on that money. This administration had promulgated the elimination of that provision, increasing capital gains, phasing out capital gains. While this administration was running for office, they said that that would only happen for people that individually made over $400,000. They've subsequently, now that they're in office, backtracked and said that would occur for any household making over $400,000. And so things have already changed. I wish I had the actual final, what the code was going to be right in front of me so we could really deal with it. But I want to warn you, it's not going to look like it's not going to come until probably later this year, possibly even after October due to budget reconciliation. And therefore, we must make these decisions and think about these things before it is too late and we lose this year. Sorry I went a little bit long today, but it was a very technical topic. I hope it was very helpful. If it doesn't help you, if it doesn't apply to you, make sure the person who maybe has a estate tax problem gets this podcast, because it's really going to be helpful information to them to take action while there's time. And that's what we always care about, maximizing wealth while we minimize tax. That is always our goal. And for all of you that are my loyal listeners, giving us 5 stars on the podcast, thank you guys. The podcast is growing by leaps and bounds. It's really appreciated. And so please remember to like it, share it with your friends and family, get more people on, and that way we can deliver more and more and more content to you guys every single week. Have a great day, everybody. Until next time.